Welcome back to Financial Cake, your go-to channel for making sense of the complex world of finance. Today, we're taking a deep dive into a moment that shook the global economy to its core, the 2008 financial crisis. We'll break down what happened, why it happened, and most importantly, explore the chilling question, could it happen again? Intro sequence with dramatic music and quick cuts of stock market tickers, foreclosed homes, and newspaper headlines from 2008. The year is 2007. The global economy seems to be humming along. People are buying homes, investments are soaring, and on the surface, everything looks stable. But beneath this calm exterior, a storm is brewing, one that would soon unleash unprecedented financial chaos. At the heart of it all was the U.S. housing market. For years, the idea of owning a home was the bedrock of the American dream. And banks were making it easier than ever for people to get a loan, a mortgage, to buy their own piece of property. Initially, these loans were given to what are called prime borrowers. These are people with good credit scores, stable jobs, and a proven ability to pay back their debts. It was a safe, predictable system. But as the demand for mortgages grew, so did the appetite for profits. Banks and lending institutions started to look for new customers, venturing into riskier territory. They began offering subprime mortgages. These were loans given to people with poor credit histories, low incomes, or unstable employment. Essentially, these borrowers were a higher risk. To offset this risk, lenders charged higher interest rates. But to make the loans seem affordable, many were structured as adjustable-rate mortgages. This meant the interest rate would be very low for the first few years, making monthly payments manageable. But after that initial period, the rate would reset, often jumping dramatically and causing payments to skyrocket. Visual, simple animation showing a small house with a low initial payment. After a few seconds, the payment amount balloons, and the house gets a for sale sign. Millions of people, lured by the promise of homeownership and deceptively low initial payments, signed up for these subprime loans. This massive influx of new buyers created a huge demand for houses. And when demand outstrips supply, what happens? Prices go up. This was the birth of the housing bubble. Home prices across the country started to climb at an astonishing rate. It seemed like real estate was a can't-lose investment. People were buying properties not just to live in, but to flip for a quick profit. This speculative frenzy only pushed prices higher, creating a self-reinforcing cycle. The bubble grew bigger and bigger, completely detached from the actual value of the properties. Visual, a graphic of a balloon inflating over a map of the United States, labeled housing prices. Now, you might be thinking, this sounds risky. Why were banks so willing to lend all this money? This is where the story gets more complex, and where we introduce a key player, securitization. Instead of holding onto these risky mortgages themselves, banks decided to package them up and sell them to someone else. They would bundle thousands of individual mortgages, prime, subprime, and everything in between, into a new financial product. This product was called a mortgage-backed security, or MBS. Think of it like a big fruit salad. The individual mortgages are the different fruits. The bank, acting as the chef, mixes them all together into one big bowl. They then slice up the salad and sell portions of it to investors all over the world, like pension funds, investment banks, and even other countries. Visual, animation showing individual house icons being bundled into a box labeled MBS and then sold off to various financial institutions. Investors love these MBS products. They paid a steady stream of income, derived from the monthly mortgage payments of all the homeowners in the bundle. And to make them seem even safer, credit rating agencies, the supposed referees of the financial world, gave many of these bundles their highest rating, AAA. This was like getting a gold star, signaling that the investment was as safe as government bonds. The agencies reasoned that even if a few people defaulted on their loans, the vast majority would keep paying, so the overall investment was secure. They were catastrophically wrong. The system was now a giant, interconnected web. Lenders made risky loans, packaged them into securities, got them stamped with a safe rating, and sold them to global investors who had no idea what was truly inside the box. The risk was no longer contained, it was spread throughout the entire global financial system. Visual, a web diagram showing connections from homeowners to local banks, to Wall Street, to global investors, with money flowing in one direction and risk flowing in the other. But Wall Street wasn't done innovating. To manage the risk of these mortgage-backed securities, they created another, even more esoteric product, the credit default swap, or CDS. A credit default swap is essentially an insurance policy. Let's go back to our fruit salad analogy, the MBS. Imagine you're an investor who bought a portion of that salad. You're a little worried that some of the fruit, the mortgages, might go bad and spoil your investment. So, you go to an insurance company, like AIG, and you buy a CDS. You pay them a regular fee, like an insurance premium. In return, if your fruit salad, your MBS, goes bad and you lose money, the insurance company agrees to pay you back for your losses. Visual, simple animation. An investor holds an MBS box. An insurance company hands them a CDS document in exchange for cash. The MBS box then starts to rot, and the insurance company gives a big bag of money to the investor. This sounds like a sensible way to manage risk, right? But it created two massive problems. The second, and bigger, problem was the sheer volume of these bets. The market for credit default swaps exploded, becoming a multi-trillion-dollar shadow banking system with almost no regulation or oversight. Companies like AIG sold hundreds of billions of dollars worth of this insurance without having the actual money set aside to pay out if things went wrong. They were collecting the premiums, assuming the housing market would never collapse on a national scale. And then, it did. Visual, the inflating housing bubble graphic from earlier now pops dramatically. The trigger was the very design of the subprime loans. Those low teaser interest rates began to reset. Suddenly, homeowners saw their monthly payments double or even triple. People who were just barely affording their homes were now facing impossible bills. With housing prices now falling, they couldn't sell their homes to pay off the loan because they owed more than the house was worth. This is called being underwater. Foreclosures began to skyrocket. One by one, then in waves, people defaulted on their mortgages. Visual, a map of the US with red dots appearing rapidly, indicating foreclosures. This was the moment the entire house of cards began to collapse. All those mortgage-backed securities, those fruit salads that were supposed to be safe, were now filled with rotting fruit. Their value plummeted. Investors holding trillions of dollars in these MBS products suddenly found them to be worthless. The credit rating agencies, who had blessed them as AAA, were exposed as being either incompetent or complicit. And what about the credit default swaps? The insurance? Everyone who had bought a CDS to protect against this exact scenario now rushed to cash in their policies. But firms like AIG, which had insured a colossal amount of this debt, didn't have the money. They were on the brink of collapse, owing tens of billions of dollars they simply could not pay. The failure of a company like AIG would have triggered a domino effect, taking down every bank and fund they had insured. It would have been a complete meltdown of the global financial system. Visual, a series of dominoes, labeled with bank names like Lehman Brothers, AIG, Bear Stearns, toppling one after another. The crisis had moved from the housing market to the core of the banking system. Banks stopped trusting each other. Credit, the lifeblood of the economy, froze. Companies couldn't get loans to pay their employees. People lost their jobs, their homes, and their life savings. The Great Recession had begun. The government was forced to step in with massive bailouts, injecting hundreds of billions of dollars to save the very institutions that had caused the crisis, arguing it was necessary to prevent a total economic depression. Visual, archival footage of politicians and central bankers announcing the bailouts. So, that brings us to today. The crisis of 2008 was a brutal lesson in greed, complexity, and a failure of regulation. But have we truly learned from it? Could it happen again? Let's look at some parallels. Today, we don't have a subprime mortgage bubble, but we see similar patterns in other areas. For instance, look at corporate debt. For years, low interest rates have encouraged companies to borrow enormous sums of money. Some of this debt is rated just above junk status, reminiscent of the risky bundles of 2008. If a recession hits, many of these companies could struggle to pay their debts, potentially triggering a wave of defaults. We also see bubbles forming in other asset classes, fueled by cheap money and speculative fever. Whether it's certain tech stocks, cryptocurrencies, or other novel investment vehicles, the psychology of fear of missing out is very much alive. Visual, side-by-side comparison. Left side shows 2008, subprime mortgages. Right side shows today, corporate debt/speculative assets. Regulation has been strengthened since 2008. Banks are required to hold more capital as a buffer against losses. The wild, unregulated market for credit default swaps has been brought partially into the light. But the financial industry is constantly innovating, always finding new ways to create complex products that regulators struggle to keep up with. Shadow banking, or lending that happens outside the traditional, regulated banking system, is larger than ever. The fundamental ingredients for a crisis remain. Human psychology, the tendency toward greed and herd behavior, has not changed. The interconnectedness of the global financial system is even greater now than it was in 2008. While the next crisis probably won't look exactly like the last one, the underlying risks of excessive debt, speculative bubbles, and unforeseen connections are still very much with us. The key is to remain vigilant, to question things that seem too good to be true, and to remember the painful lessons of the past. The story of 2008 is not just a piece of financial history. It's a timeless warning. Thanks for watching. If you found this breakdown helpful, be sure to subscribe to Financial Cake and hit the notification bell so you never miss an analysis. What do you think? Are we heading for another crisis? Let us know in the comments below. See you next time.